a little unsettling. Nobody doubts that the potential for problems exist. Two professors at the Massachusetts Institute of Technology, Andrei Kirilenko and Andrew Lo, once wrote that whatever can go wrong will go wrong faster and bigger when computers are involved. Have to agree with that. The idea that we might get caught in a massive computer glitch probably isn't your worst nightmare, but it'll make the list of the top 10 for a lot of people. That's only half the reason people worry about computerized stock trades. The other half is the sense of being overwhelmed by the gigantic trading volume and incredible speed that computerized markets offer. We don't just feel like a minnow among sharks, we feel like a very slow minnow at that. I think that fears of computerization are overblown. Yes, big mistakes can happen in the stock market if a system fails or if someone programs a computer wrong. But that's no different than it is for, say, airline reservations or credit card statements. We'll first take a look at what can happen to traders if they're caught in a glitch. After that, we'll see if we can get a bit more comfortable with our status as slow minnows. Heavily automated trading platforms and computers placing orders can be scary. Mistakes happen. My favorite is the August 1st, 2012 Knight Capital Group debacle. Knight Capital, a financial services firm, endured, and I quote, "A technology issue at the open of trading at the New York Stock Exchange related to a software installation that resulted in Knight sending erroneous orders into the market." That's a marvelous understatement. Knight had lost about 4 times its annual earnings in just a few minutes. The next day, Thomas Joyce, Knight's CEO, explained what had happened. Knight had installed new computer software to trade on a new NYSE program. Unfortunately for Knight Capital, the software sent huge numbers of erroneous orders on almost 150 different stocks. Joyce explained, "It was a software bug, except it happened to be a very large software bug." Nobody can correct that many bad orders in a short period, so Knight had to eat the losses from those trades. Those losses were huge. This software glitch cost Knight $457.6 million. That was just about the entire value of the company. Knight was lucky in that it was able to get cash infusions from other institutions within 24 hours, but only at the cost of surrendering its status as an independent firm. The market showed no mercy. You mess up, you lose. I can't think of a regulatory agency anywhere in the world that could be so ruthlessly efficient. Mistakes can happen too. Badly programmed computers placed lots of erroneous orders on May 6, 2010, contributing to what's now called the flash crash. Securities exchanges decided that prices were way out of line during the flash crash, so they canceled over 20,000 trades that were executed during those few minutes. It's unclear how prevalent such problems are, though. Maybe the biggest danger is to the trading firms that use them. If your computer algorithm is going to be trading in milliseconds, then the computer code had better be right. Knight Capital showed us that you can lose enormous amounts of money in the blink of an eye. How might computerized trading affect you personally as a participant in the stock market? A consistent theme throughout our lessons is that people like us shouldn't try to be active traders and try to pick winners. For the most part, we're going to buy shares and hold them for a fairly long time. We simply can't compete with experienced trading firms that have invested gigantic sums of money in technology and who study markets just about 24 hours a day, 7 days a week. Take, for example, Project Express, owned by undersea telecom operator Hibernia Atlantic. Project Express was designed to shorten the cable link across the Atlantic to shave just 5.2 milliseconds, that's 5.2 thousandths of a second, off the execution time of the previous speed champ, the AC-1